Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're taking a deep dive into Wells Fargo's second quarter 2025 earnings results that just came out this morning. We're going to pull out the essential nuggets, the key numbers, what management's really saying behind the slides, and most importantly, what it all means for Wells Fargo's path forward and, well, for you. Okay, let's get straight to the headlines. Wells Fargo posted revenue of $20.82 billion. That actually edged out the consensus estimate, which was $20.76 billion, just slightly. And maybe more notable, diluted earnings per share, EPS, came in strong at $1.60. The street was looking for $1.40. So a solid beat there. Their efficiency ratio, always a key metric for banks, right? How well they manage costs, came in at a pretty lean 64%, shows discipline. And on capital, their common equity tier 1 ratio, the CET1, it nudged up to a robust 11.1%, well above the minimums.
Yeah, but it's kind of a classic Wall Street story, isn't it? You get these really strong headline beats.
Yeah.
But the market's focus, it's just boom, immediately zoomed in on one thing. Net interest income, NII, at $11.71 billion. NII actually missed expectations. And that's really where the whole narrative around these earnings took a sharp turn.
Yeah, the NII miss definitely soured the mood a bit.
It really did. It just highlights how much investors still anchor on that traditional metric, even if there's maybe a bigger strategic story happening underneath.
Okay, so let's pivot to what many saw as maybe the biggest win this quarter, the lifting of the asset cap. Now, this isn't just about, checking a regulatory box, is it? What does this really unlock for Wells Fargo that they couldn't do yesterday, beyond just saying flexibility?
Oh, it's way more than checking a box. You're right. The truly significant thing here is the freedom it gives them on the balance sheet. For years, Wells Fargo was, essentially handcuffed, right? They had to turn away corporate deposits sometimes. They were cautious with consumer loans, even passed on some good corporate deals because they just couldn't add the assets.
Right, hitting that ceiling.
Exactly. Now, management can completely reallocate their time, their strategic focus. It means, yes, proactively growing deposits, but also selectively expanding loans, especially in those higher margin areas like corporate and investment banking, CIB. And crucially, they can now allocate more capital, more balance sheet to their markets business, drive profitability through, increased trading, financing activity. It's a fundamental shift. They're moving from managing constraints to actually driving proactive growth.
Yeah. Okay, so the cap's off. They have freedom to grow, which brings us straight to capital. They've got the strong balance sheet, CET1 at 11.1%, like we said. And maybe even more impactful, their expected stress capital buffer, the SCB. It's set to decrease by 120 basis points starting Q4. That significantly lowers their required capital levels.
Yeah.
So with all this capital, all this regulatory relief, how are they planning to actually use it? What's the deployment strategy?
Yeah, that's the multi-billion-dollar question, isn't it? Deployment strategy. Management was very clear. They're committed to returning capital to shareholders. They highlighted, they've already cut average common shares outstanding by 23% since 2019. Mm-hmm. That's significant.
Buybacks.
Right. And they announced a 12.5% hike to the third quarter dividend. Takes it to 45 cents per share. Plus, the board authorized another $40 billion stock repurchase program.
Wow, $40 billion.
Huge number. But, and this is key, they also emphasized a very deliberate hierarchy. A pecking order, if you will. Organic growth comes first, then dividends, then buybacks.
So not just opening the floodgates immediately.
Exactly. It's not a spend it all now kind of approach.
Yeah.
It signals a more thoughtful, phased strategy. Prudent, maybe.
Okay, let's shift gears a bit. Away from the sort of big balance sheet, capital structure moves, what's actually happening on the ground? In their business lines, it sounds like they're seeing some real momentum in places. Where are the bright spots?
Yeah. There definitely are some. We're seeing gains in their credit card business, for instance. New account growth is up. They even got recognized by J.D. Power for their mobile app and online satisfaction. That helps.
Okay.
Their auto business, interestingly, saw its first linked quarter growth. So growth from Q1 to Q2 in over 3 years. That's a notable turnaround, driven by some new agreements they signed.
3 years, huh? That is a turnaround.
It is. And in consumer banking, primary checking accounts are growing. They said it's fueled by marketing spend, digital improvements, and they're actually expanding their branch footprint, adding branches in places like Chicago, New York City, Nashville, which kind of goes against the grain sometimes.
Investing back into branches, yeah.
And look at corporate and investment banking. Those investments are really paying off. Investment banking fees jumped significantly. They're gaining market share in areas like leveraged finance, M&A advisory. They're actively hiring more bankers in key sectors like tech.
So building that out.
Definitely building. Yeah. And one more thing on simplification. They agreed to sell their rail equipment leasing business. Management basically framed it as, the last significant divestiture in their long-term strategy to streamline the bank, really trying to focus the portfolio.
Okay, makes sense. Get rid of non-core stuff. Now,
Right.
let's circle back to that number, the one that seemed to catch the market off guard, the NII. Despite all those positive beats we talked about, management actually trimmed their 2025 net interest income guidance. They now expect it to be flat year on year. This feels like the elephant in the room. How do they explain this, especially given that negative market reaction?
Yeah, this is absolutely the crux of the market skepticism right now, no doubt about it. The core explanation, it really comes down to a strategic reallocation. It's about where they're putting their balance sheet to work. They've decided to dedicate more capital, more balance sheet to their markets business than they originally planned earlier in the year.
Okay.
Now that markets activity, think trading, financing, it could be low or even non-earning from a strict net interest income perspective. But the revenue it generates, that shows up in non-interest income, fees, essentially.
So it's a mix shift, moving revenue from one line item to another potentially.
Precisely. It's a mix shift. So it hits the NII line specifically, which the market watches like a hawk. But ideally, the goal is to maximize overall profitability, total revenue, total return. They do still expect NII itself to grow sequentially, meaning quarter over quarter, in both Q3 and Q4.
Okay, so not falling off a cliff, just flatter for the full year.
Right. And on the loan side, they see modest growth coming in the second half, mostly from CIB, corporate and investment banking, maybe some consumer growth in cards and auto too. But the challenge, and they were clear about this, is intense competition for loan yields, mainly from other banks fighting for the same deals.
Pricing pressure, always a factor. Now, you mentioned discipline earlier. It feels like Wells Fargo has been on an expense-cutting mission for, years now. They've reduced headcount for 20 consecutive quarters. That's 5 straight years, a 23% decline in staff over that time. What's driving this relentless focus? And how much more room do they really have to cut costs without maybe hurting those growth plans?
It's a fair question. And this continued focus on efficiency, it's absolutely crucial to their story. Management made it really clear they are not, repeat not, sacrificing returns just to chase growth. That's the message. Instead, they're strategically driving these efficiencies, the headcount reductions, process improvements, specifically to help fund those critical investments we talked about.
Using the savings to invest.
Exactly. Funding things like higher marketing spend, hiring those bankers in CIB and other areas. It's about reallocating resources internally. They also mentioned, kind of briefly, seeing some early benefits from AI initiatives, call centers, maybe the branch system. Small stuff now, but they expect that to build over time.
Interesting. AI creeping in.
Oh, and one important clarification they made. They reported 15% return on tangible common equity, ROTCE, this quarter. It included a one-time gain from selling part of their merchant services joint venture.
A one-off boost.
Right. So they were careful not to declare victory on hitting that 15% target consistently just yet, managing expectations there.
Okay, that makes sense. So pulling it all together, what does this mean for you listening in, whether you're an investor or just trying to understand big banks? The market's reaction, down 5.5% on the day, it clearly shows that laser focus on forward guidance, especially NII, even when the current quarter's headlines look good. It feels like the initial excitement, maybe overexcitement from the asset cap removal, set a really high bar. And that NII guidance definitely brought things back down to earth. But management sounds pretty optimistic about this whole strategic pivot. What are the biggest maybe headwinds or challenges they face in convincing the market that this NII thing is the right move long term? Especially given, Wells Fargo's history. Is it hard or sell?
That's a really vital point. The challenge now for Wells Fargo is execution and then proving it. They need to effectively pivot the balance sheet to those higher returning fee generating activities like they say they will, and then show the market the results. Quarter after quarter. Management is optimistic. You're right. They talk about the newfound flexibility, the growth opportunities, boosting consumer accounts, grabbing investment banking share. They do acknowledge uncertainties, though, particularly around global trade. Some of their commercial clients are apparently bracing for potential downside risks there. So that's a macro factor.
External risks.
All right. But their core confidence seems to be that removing these old constraints, combined with the continued efficiency drive, will ultimately lead to sustainable growth and higher returns. Over the medium to long term, though, it's definitely become a show-me story from here on out. The market wants proof.
All right, makes sense. It's time now for our This Is Not Financial Advice segment. This is where we stretch our thinking a little, maybe get a bit creative, and pitch an outrageous, but perhaps surprisingly plausible trade idea based on today's deep dive. What have you got for us?
Okay, given everything we've unpacked from the Wells Fargo call today, here's a cheeky one to chew on. For the bolder investor, perhaps. How about this? A tactical long position in Wells Fargo itself, ticker WFC, paired with a short position in maybe a less diversified regional bank, one that doesn't have these massive regulatory tailwinds, no asset cap coming off,
Okay. Long WFC, short a regional peer. What's the thesis?
The core thesis is basically that the market totally overreacted to that NII guidance tweak. Remember, our view is that it's largely just a revenue recognition shift. It's accounting, driven by allocating more balance sheet to those higher fee, lower NII generating markets businesses now that the asset cap is gone.
Right, the mix shift we talked about.
Exactly. So that 5.5% slide in WFC stock today on pretty high volume, that might actually create a compelling entry point, tactically speaking. Because Wells Fargo is, you could argue, uniquely positioned now. They can organically grow deposits and loans and redeploy significant capital through both buybacks and higher dividends. Many of their regional peers just don't have that same capacity, that same flexibility right now.
Interesting angle.
So this temporary NII headwind, it's arguably part of a necessary longer-term strategic pivot, a pivot towards maximizing overall returns, total shareholder return, not just optimizing the NII line in isolation. The outrageous part, I guess, is betting that you understand this NII accounting nuance and the strategic pivot better, or at least faster than the broader market, which might still be stuck on those traditional NII metrics for a bit longer.
A bet on nuance versus the headline reaction.
Got it.
Okay, so today we really peeled back the layers on Wells Fargo's Q2 earnings. We saw a story, kind of a classic one, of strong headline beats, but they were, for many in the market at least, overshadowed by that cautious outlook for net interest income.
That's right. But beneath that immediate, maybe knee-jerk market reaction, there's a company gaining really significant flexibility after years under regulatory clouds. They're systematically streamlining the business, making strategic investments for growth. The focus, the real test now, shifts to execution. How effectively can they translate this newfound freedom into sustained higher returns and really rebuild that market confidence for the long haul? It's a fascinating strategic pivot to watch unfold.
Absolutely. That's our deep dive for today. And just a reminder, this discussion is purely for informational purposes. It should definitely not be considered financial advice. Always do your own research. We appreciate you joining us on the deep dive.